Hi, I'm Max Keiser. This is the Keiser Report. The shakedown times are here. They're going to take all you hold dear. Bailouts and bail-ins and pension fund confiscations. It's the law of the land now, matey. And we all got to abide by that law, matey. Hey, this sounds like a John Cooper Clarke poem, sort of. Maybe, matey.
Maybe I was thinking.
Let's get John Cooper Clarke back on the show. John Cooper Clarke, come on back on the show.
He did predict the onesie would become a big deal, and he was right about that.
Yeah, now this year is the twosie.
The two.
I want a twosie for us. I want a Christmas twosie for Max and Stacy. That's
what the Keiser Report is all about. We're a twosie. So, you know, you're talking about the shakedowns, the bailouts, the bail-ins. Well, here's a headline that we're getting to now. We didn't cover it last week, but I decided we'd cover it now. New G20 financial rules, Cyprus-style bail-ins to confiscate bank deposits and pension funds. So on November 16th, when the G20 met, all the headlines, of course, were about, the leaders shirt-fronting Putin, and that's all they cared about. But behind the scenes, many people might not have seen that they rubber-stamped the Financial Stability Board's adequacy of loss-absorbing capacity of global systematically important banks and resolutions, which basically rewrites of banking, and that deposits are now just part of commercial banks' capital structure. That means they can be bailed in or confiscated to save the mega banks from derivative bets gone wrong.
Bail-ins, baby. Bail-ins. What's the phrase? The what? The who? The how do you say that?
It's a long one. It's called adequacy of loss absorbing capacity of global
adequacy of loss absorbing capacity. What else?
Systematically important banks and resolution.
Adequacy of loss absorbing capacity, systematically absolving all financial criminals like Jamie Dimon of thieving and molesting and pedophilia and all the everything else that they engage in on a daily 24/7 basis because they're Wall Street crooks, they're City of London crooks, they're the kind of guys that would sell their mother out for a nickel. They want to bail in the money. They want to open up your bank account and say, no, we need this to back up the collateral for our derivatives products. We don't believe in savings, we don't believe in jobs, we don't believe in wages, we don't believe in God, we don't believe in country, we don't believe in nothing. All we believe in is confiscation, thieving, molesting. We're Jamie. We're Jamie. And who's running Barclays now? I saw him over the weekend at a cigar shop in Mayfair. This guy Jenkins. He's there. Yeah, I'm Jenkins. I believe in thieving. Yeah.
Well, the derivatives laws that Jamie Dimon did lobby for in America are different from this one. And you notice that they call it banks in resolution because this is a new word for banks in bankruptcy. They used to be bankrupt, now they're in resolution. What was formerly called a bankruptcy is now a resolution proceeding. The bank's insolvency is resolved by the neat trick of turning its liabilities into capital. Insolvent TBTF banks are to be promptly recapitalized with all of their unsecured debt so that they can go on with business as usual.
Right, they turn their liabilities into capital. When you make a deposit in a bank, the bank carries that as a liability. So, resolution is just another word for stealing. And on this show, what we like to do is we like to keep track of all the nomenclature and all of the word tricks that go on every 6 months because they get caught committing a fraud or a crime. So instead of stop committing that fraud, they change the name. So here, like MF Global with John Corzine and Jamie Dimon. Jamie got caught stealing $1 billion. But now, since they don't did anything against Jamie, they didn't say, Jamie, don't steal. They said, oh, let's just call it resolution. And now Jamie Dimon will be back in the marketplace, and he'll stick his big fat paw into the banking system, and he'll grab more of people's assets. And it says, no, it's a resolution. It's under a new clause. It's under a new law. Barack Obama is somebody who lives in my underwear, who tickles my all day, and that's his primary job. I mean, it's a farce. I mean, you look at Jamie Dimon, and out of his trousers, you see a little Barack Obama doll. Hi, I'm Barack Obama. He lives in there.
Well, so they're saying that they're recapitalizing with unsecured debt. What are unsecured debts? Well, unsecured debt includes deposits. The largest class.
I just said that.
I know, and that's what I'm reading here from the article. It says the largest class of unsecured debt of any bank. The insolvent bank is to be made solvent by turning our money into their equity. Bank stock that could become worthless on the market or be tied up for years in resolution proceedings then become the power statutory Cyprus-style confiscations to become the law. So basically, our deposits become their equity in the case of a financial crisis, like it seems like we're on the verge of, because if you look everywhere, every single currency, every single precious metal, every single oil price, all Baltic Dry Index, they're all looking exactly like 2008 when we had a global financial crisis caused by subprime mortgages. Here it's caused by a junk bond market, on energy shale plays. So they've told you the future. So if you get caught, if you have your deposits recapitalizing some bank somewhere, it's your fault.
Right, your bank, the deposits are now of the dominion of these derivative-wielding financial terrorists. And there's Barack Obama. Hello, I'm Barack Obama. I love Jamie Dimon. Boinky, 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 boinky.
Well, those on the verge of retirement might think, well, maybe I'm going to retire now to get out of this, escape this, this disaster coming. Well, headline reads, Congress has moved one step closer to allowing pension cuts. So, as it stands right now, pensioners who are already retired cannot, their pensions don't get cut in the case of bankruptcy or any other sort of restructuring or resolution, as they call it now. But more than 1 million retired and current truck drivers, construction workers, and other union workers could see their pension benefits cut now that Congress has passed a proposal aimed at shoring up some of the nation's biggest pensions. This was stuck in that $1.1 trillion budget bill. The deal sorted on that. Well, multi-employer pension plans cover more than 10 million workers, and retirees force and major investment losses from the recession. So they've already lost all their money from the last crisis. Now, because of that last crisis, we're not even into the new crisis yet. Well, they're having to make pension cuts, and Congress is saying, well, you can just, all those people that have an obligation, that deferred pay to put into their pensions for all those years, well, you can cut their pension benefits.
Right, they dropped interest rates down to zero, and stole all money from savers to keep the zombie banks alive. But the zombie banks are still breeding, they're still require more money. So now they're going to go after all the pension money. They're going to go after all the unions. They're going to go after all the passive cash that's sitting there in people's bank accounts, whether it's Jamie Dimon taking it through resolution. Now they're going after pensions. They took everyone through low interest rates. So they're taking it all. This is a plague model. It's a bubonic plague of finance. Put together by central banks to essentially infect the globe with deflation. Remember, quantitative easing causes deflation. Jamie Dimon causes deflation. Wealth confiscation is deflationary. Deflation is the opposite of growth. With no growth, there can be no wages, there can be no GDP growth, there can be no life on this planet as we know it if we let these terrorists and bubonic plague, financial plague wielders continue to propagate deflationary policies like quantitative easing, wealth confiscation, wage destruction, and political co-option through, I wish the senators and congressmen in America would take more money to be bribed, because that would be inflationary. The senators and congressmen in America, instead of giving you $100,000 to take bribes for the MPAA or the IRAA or some other lobbyist group, if you ask for $500,000 or $1 million, that would cause inflation and get the economy going. Take more money to be bribed, American congressmen and senators, please. Have more self-respect in your venality. Have more self-respect in your criminality. Please raise the price of the bribes needed to get you to throw the country under the bus so we can have some inflation.
Well, let's look at the deflationary impact that will have on this one guy, a retired trucker, 64 years old, retired trucker driver. Glenn Nicodemus, 64, receives his pension checks from the Central States, Southeast, and Southwest areas pension fund, which is struggling to cover more than 300,000 retirees, widows, and others. Under the congressional proposal, Nicodemus could see his annual benefits plummet from around $40,000 a year to as little as $15,000 a year. So obviously deflationary. This is coming. And you mentioned the 0% interest rates, which drove all these pension funds. His pension fund will have dove into the junk bond market, which was lending to these shale gas and oil plays for 4.5%. All of those are going to blow up. Who knows? So he thinks he's going to get 15,000. It's probably going to be 7,000 by the end of it.
Right. They're putting people into a financial ghetto. This is a ghettoification. You're on the wrong side of the apartheid interest rate wall. You're not a friend of Goldman Sachs. So you're being put into a ghetto.
And of course, those pension benefit cuts won't apply to those Congress people you were talking about taking bribes. No. They'll always have guaranteed increases in theirs.
Because it's apartheid.
Yeah.
They're the new white boys. So they, no matter what their skin color is, they're on the right side of the apartheid wall. They're not living in the ghetto engineered by the financial terrorists that are forcing millions into this financial ghetto.
Now, speaking of being forced into a ghetto, here's our final headline here. Ferguson to increase police ticketing to close city's budget gap. So apparently there's a $1 million budget gap in Ferguson, Missouri. We've all seen the riots, right? Well, Ferguson's finance director, Jeffrey Bloom, says, there are a number of things going on in 2014, and one is a revenue shortfall that we anticipate making up in 2015. There's about $1 million increase in public safety fines to make up for the difference. So they're planning on going out and harassing people, which is part of the set the environment for those Ferguson riots, by the way, is that the police are constantly shaking down people, nickel and diming them for, alleged things like turning right on red or when they shouldn't at that time.
Yeah, Ferguson is America's crystal nut. And going forward, we're going to see more of the shakedown and ghettoification of the people that are not directly involved in the system which favors kleptocracy.
And also, whether it's in Mexico or it started in Tunisia with Mohamed Bouazizi, remember that the Tunisian fruit seller, he started the revolution, the Arab Spring, because they kept shaking him down. The police kept shaking him down. He needed to pay the bribes to sell his fruit, and he didn't have the money to pay the bribes. So what they did is they destroyed his stuff, and he lit himself on fire. By the way, I want to say what his last words were: "How do you expect me to make a living?" And this is the same thing across the U.S. as they start shaking down, as they start taking your savings, confiscating your savings to bail out a bank, confiscating your pension funds to bail out the government, confiscating whatever cash you have in your car because you happen to be stopped by some thug policeman.
Civil forfeiture.
Yeah. So, people
can't breathe. I can't breathe.
You're going to see masses of people lighting themselves on fire. How do you expect me to make a living?
Right. They're going to nickel and dime them to death, and people have more respect by self-immolating themselves and going down in a blaze of glory, literally, than to allow themselves to be nickel and dime to death by bureaucrats, kleptocrats, monarchs, loving Jamie Dimon buddies who think nothing of wealth confiscation in the name of funding the creation of weapons of mass financial destruction. That's what he's all about. In
Ferguson, by the way, they're expecting the revenue from violations to increase by 15.7% in 2015. They're already foreseeing that. They're already creating a situation where they're going to take money from you, cause more stress, more conflict, and more desperation.
Yeah, well, more grist for the mill. So the human life is worthless in America. That's unfortunately
around the world, baby. Around the world.
It's really cheap in the U.S. now. Okay, Stacey, thanks so much for being once again on the Keiser Report. Thank you so much. You're worth something, especially my Tuesday.
Okay, I'll see you in our Tuesday next year.
All right. Well, stay tuned for the second half. A whole lot more. Welcome back to the Keiser Report. I'm Max Keiser. Oh, wow, this is a real treat. Let's go to Florida and speak with Carl Denninger of market-ticker.org. Carl, welcome back to the Keiser Report.
Thank you, Max, for having me on.
All right, Carl Denninger. We've got a situation here. The oil price collapse. What impact is this having on the credit markets, and is that negative impact outweighed by the positive consumer impact, Carl Denninger?
Well, it's a very large negative impact because these shale and fracking drillers have issued somewhere between $500 billion and $2 or $3 trillion worth of debt over the last few years, depending on who you talk to. I've seen numbers all over the place. And of course, we all know how accurate everyone is when you see a range like that. It sounds an awful lot like subprime, right? It's contained. It's only $20 billion. And then it turns out that it blows up the world. The other thing, though, to keep in mind is that even in the United States, this supposed consumer positive is outweighed by the fact that you have all this employment and construction that's been going on in the states where the fracking and the shaling is happening, and that's all going to come to a stop. So I'm not at all convinced that this is positive on net, at least in the United States, even for us. And of course, in other countries where you have a consumption-based system and there is no alternative energy drilling going on, it would be a positive. But here in the U.S., I'm not sold on that.
Okay, so you mentioned 2008, and let's roll with that a little bit. So going back to 2008, people were saying, oh, wow, we're making mortgages available to people who don't really have the credit to get a mortgage. They don't have the income for the mortgage. And isn't that great for the economy? Everyone's going to own a home. But in the background, there was this huge leveraged play that was reaching a tipping point, and then it exploded. So my question is, people on the front end of this are saying, oh, wow, gas is cheaper, but behind the scenes is this enormous extended credit bubble tied to the oil price, assuming that it would stay around $80 or higher, and here it is around 50 to 60, and similar to the subprime crisis. Is that a fair analogy, Carl?
Yes, except that the sector level impact is smaller. But then again, remember that back in 2000, we had one little sector, namely tech companies with no earnings and no prospect of ever making them, that blew up the stock market. So this sort of thing is kind of the unknown unknown at this point, in that although all the analysts are saying, well, you know, there really isn't that much credit impact other than this little area of high yield, I'm not sold on that, because as you know, Max, these guys like to sell this debt off into various markets, and then people start writing derivatives against it. And we don't know exactly how many derivatives are out there against this stuff. So I think there's a problem there. But the other side of the impact on this is in municipal budgets. You have cities and towns and states even where this fracking and this shale drilling have been going on. They've been putting up new schools. They've been issuing bonds. They've been doing all kinds of spending on infrastructure. And if these drillers go out of business and this becomes an unviable thing to pursue, those bonds have already been issued. That debt is out there, and it will have to be serviced. So the negative roll through on this over the next 5 to 10 years, assuming that prices stay down, could be very significant.
All right, so I want to switch gears here a little bit and talk to you a little on a slightly different topic. Carl Denninger, of course, is the author of Leverage, which is a fantastic book, and you really dig down into the I would say the entrails of the banking system, looking at the actual MZ and all these other numbers that make up the actual reality of the. Let's talk a little bit about another crisis. The G20 signed on to what they call the Financial Stability Board's Adequacy of Loss-Absorbing Capacity of the Global Systemically Important Banks and Resolution. Okay? Which allows for confiscation of deposits and pension funds. Your comments, Carl Denninger.
Why is it that every time that Wall Street and their minions in other countries start gambling with other people's money, that they manage to put the gambling debts in front of other people's cash? You know, it used to be that deposits were the first claim in an insolvent financial institution, and everybody else had to go to the back of the line after that. And that makes perfect sense, because when you deposit money in a bank, you're not looking at this as making a loan to the bank, even though technically you are. You're looking at them as essentially putting it in a safe deposit box, which of course they're not. So unfortunately, through time, this protection has been eroded. And in the United States, we just had our wonderful Congress allow the trading of these derivatives back under regulated and insured entities, which was removed from them under Dodd-Frank. That was a little, I guess you could call it Christmas cheer for Jamie Dimon that was slipped into the bill that was just passed to fund the government. So yeah, the games are still going on, and we haven't seen any change there.
Right. Well, it's interesting that Dodd-Frank, of course, or any of these pieces of legislation that come after these collapses, then after a few years' time, the banking industry just gets lobbyists to work their way back to positions that were before these reforms, and during that period of time, the amount of debt and leverage in the system keeps on rising. And here's another thing: Congress also restored the derivatives exemption. Can you talk about that? What is it, and what does this mean, Carl Denninger?
Well, that's what I was referring to with regards to the recent budget bill that just worked its way through the House and the Senate. Dodd-Frank took out the bank's ability to trade derivatives in their regulated subsidiaries. Those are the ones that are covered by government deposit insurance, and said you must put those derivative trades into a subsidiary that has no government protection. So if something goes wrong, too bad, so sad, you lose, and that's just the way it goes. Well, Jamie Dimon apparently didn't like this very much, and so he made some phone calls to Congress people, and among them and some of the other lobbyists got a provision stuck into the budget bill, which has nothing to do with the federal budget, by the way, that says that it's perfectly okay for the banks to start trading that stuff back under their regulated arms again. So once again, the taxpayer is back on the hook for the gambling debts of Wall Street.
So correct me if I'm wrong, but we had two things happening at the same time. Number one, they made it easier for banks to claim, put depositors at the end, back of the creditors at the end of the line. So the depositors are no longer first in the case of a bankruptcy, which they now call resolution. But in other words, it's a bankruptcy. So depositors are less safe than ever before. And at the same time, the banks have been given the ability to essentially leverage up their derivatives book to even greater levels. And these things are happening simultaneously, correct?
Yes, and the biggest problem with the derivatives is that there's no capital behind any of those. We found that out when AIG got in trouble. They'd written $500 billion worth of derivatives and had no money. So, it's like going into a casino in Vegas and saying, I'm going to bet $1 million on red, but oh, by the way, I don't have $1 million. And then when the number comes up black, then you turn your palms up and say, oh, well, the taxpayer needs to make that bet good. And see, this is part of rigging of the financial system that allows these institutions to report profits. But the reality is that you're supposed to put your own capital at risk when you earn an alleged profit. And that means that when you make a bad decision, you lose your money.
All right, Carl, I want to, this period of 2008 comes up again as a point of reference. Now, if I remember correctly, leading up to the crash of 2008, the stock market was kind of going up and things looked great, but banks were buying insurance on each other. And we saw this in the derivatives market because they knew that they each held really bad securities, and so they were trying to insulate themselves. At the moment, if you look at the credit spreads and you look at the derivatives market, you see that banks are once again kind of buying insurance on each other, but the markets are still trading near all-time highs. Is this telegraphing something to us? Can we read into this that the banks are kind of positioning themselves for something that's not generally known by the public, Carl?
Maybe. But remember that what happened in 2008 was that we found out that none of these guys that were writing this insurance had any money to pay. So this game is really about regulatory arbitrage. It's about being able to go to the Federal Reserve or the ECB or whoever your regulator is and say, a little dodgy, but I have an insurance policy in case something goes wrong. It's not about actually being protected in the event something bad happens. It's about being able to say you're protected. And those are two very different things. It's kind of like buying fire insurance from a company that doesn't have any money just so you can say you have fire insurance. It has nothing to do with if you actually have a fire.
Okay, so in other words, put it another way, these banks like JP Morgan, they know that their securities that they have in their books are pretty much worthless, but the game is on this regulatory arbitrage game is to try to get Congress and other regulatory bodies to just lower the bar in terms of being able to treat them as collateral or to be able to classify them as something that's either on the books or off the books. So it's completely just gaming the system. They have absolutely no earnings, honestly, made whatsoever. I want to go to my last question, which is that, and talk about the consumer a little bit. The expectations for a better job market help power the University of Michigan Index of Consumer Sentiment to a new 8-year high in December that mirrors the boom years of '96 and 2004. Consumers are very positive, Carl. Are they right? Are they wrong? What can we say about this?
Well, if they're so right, where are the sales coming from? Because the retail sales report, despite the headline, was worse than the same month last year in terms of gains. Remember, we have this little holiday called Christmas when people tend to go out and shop, and that starts right around the end of November because of Thanksgiving. So the retail sales report tells an entirely different story, and the jobs report, while the establishment survey was very positive, when you look inside the household survey, which actually tells you what people really did because they actually call people's homes, that report wasn't positive at all. So we have a series of numbers coming out of the government that all appear to be cooked. I don't have any idea what sort of integrity you've got in this consumer confidence survey and its methodology. But what I do know is that when I look at the raw data, not the adjusted, the seasonally adjusted numbers that everybody likes to rely on, but the actual raw data and compare against last year, say much less previous years, they don't look good at all.
All right, Carl, we've got about 20 seconds, and I just want to ask you quickly, can you give me in 20 seconds a prediction for 2015, Carl Denninger?
I think the credit problems in the oil patch, assuming prices stay low, start to show up in the first and maybe second quarter of next year, and that's when the fun begins.
All right, fair enough. Carl Denninger, thanks so much for being on the Keiser Report.
Thank you.
All righty, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacey Herbert. I'd like to thank our guest, Carl Denninger of marketticker.org. If you'd like to get in touch, tweet us at Keiser Report. Until next time, bye, y'all.